Hello, also I'm back again. So a few of the metrics I will discuss about which are most important towards analyzing the financial statements of the company or towards analyzing the stock of the company. And these things need to be taken into consideration whenever we are looking into the financials of the company or trying to forecast the future prospects of the company, trying to make a decision of whether the company is good or not good, right? And I would be listing a few of the metrics which I do personally, which I use personally, and there might be some other metrics as well. So feel free to list down those metrics in the comment section. So the most important metric which I use personally is free cash flows. Though we try to calculate the free cash flow per share, but ideally to calculate the free cash flow, the FCFF of the company. Though theoretically, we try to calculate the free cash flow to share by taking into consideration your earning before interest and tax EBIT into 1 minus taxation, adding back your depreciations and the amortization expenses and subtracting the capital expenditure and the change in working capital needs to calculate the free cash flow to firm. But going aside or keeping aside the theory, we try to understand what exactly is the free cash flow to share. Is the final cash flow available to all the capital providers of the company which have invested their money into the company, which clearly indicates how much actual idle cash the company has after paying off for everything, right? And ultimately the free cash flow per share, as I told you the calculation, how to calculate that, it basically tells you how much actual cash the company has. Because I believe not for all the companies, but the profitability of the company can be manipulated. Here I'm not saying the profitability of all the companies get manipulated, but it can be in a straightforward way, I'm telling you all. Because the profitability is something, whenever you are trying to calculate the profit of the company through the profit and loss statement or the income statement of the company, we tend to take into consideration sales component. That sales component is inclusive of both the cash sales as well as the credit sales. So the credit sales component might be inflating your profitability because the amount for the sales which have been made to the people to whom the money is still yet to be recovered have not been recovered yet. I'm not saying 100% of the time the amount might turn to be bad debt, but there is a possibility. Even if there is a 0.5% possibility, there is a risk of the inflated numbers. So one thing is that we need to understand as well, right? It can happen that the company might not be able to recover that money out of those credit sales, correct? And that amount might turn out to be a bad debt or as a part of a higher debtor amount in the subsequent quarter. It might be inflated as a higher profit number through the P&L statement, but the higher amount of debt or a higher amount of bad debt might be there in the subsequent quarter. So this thing we need to take into consideration. In this way, the profit can be manipulated, but the cash flows cannot be manipulated because the cash flow is something which is recorded only after the actual cash is received. It won't calculate that component of the expected credit sales amount which has to be recovered. It will just calculate the actual sales, actual cash which has been received through the actual sales. And that is why I personally focus upon the free cash flow to the firm, or in most of the cases free cash flow to equity as well in certain scenarios. For the banking companies, for the NBFCs, insurance companies. The reason we can discuss somewhat later that why do I use FCFE instead of FCFF for banks, right? But the thing is, the profitability of the companies can be very high. The company might have super profitability, but the cash flows of the company might be negative. In that case, why to go for such companies, right? So this thing we have to take into consideration. So not only just focus towards the profitability, go towards the cash flows, right? And there can be certain scenarios when the profitability is not so high, but the cash flows are very high. Even in that case, the company can be good, taking into consideration other parameters as well. The second metric which I take into consideration is the ROCE, and the third one is the ROE. ROCE stands for the return on capital employed and ROE stands for the return on equity. So when do I use the return on equity? So ROE is nothing but it is the amount or the profit, your PAT, the profit after tax divided by the outstanding shares. How much profit were the shareholders able to reap from their investment, from their equity investment into that particular corporate. And when I talk about ROCE, the return on capital employed, it takes into consideration your EBIT into 1 minus tax divided by the amount contributed by the equity shareholders, the outstanding shares, plus the debt amount, the total capital employed. Because that EBIT is something which is available to the total capital providers. And that is also we need to understand that why do we use EBIT in ROCE and PAT in ROE, sorry, because in ROE it's a profit available to the shareholders. It means we have subtracted that interest component from the earnings before interest and tax, so that interest component has been subtracted, and whatever is left out is available for the equity shareholders only. But when we talk about the debt holders, or like when we talk about the ROCE, is the profit available to both the capital providers, with the equity holders or the debt holders. That is why in that case we use EBIT in the numerator, because the interest has not been subtracted yet. The EBIT is the total profit available to both the equity holders as well as the debt holders. So one thing that we need to understand is that whenever the company has only equity and no debt, always use ROE, because in that case ROE and ROCE will give you the same number. But if the company has debt, always use ROCE, never use ROE. The number might be inflated. Why? Because in ROE, in ROCE, we have EBIT by the total capital employed, and in ROE we have the PAT by the outstanding shares. So if the company has debt and we are using ROE, the equity component in that ratio might come down drastically. The part of denominator of that ratio will come down drastically, and the ratio will be inflated, and that will not give you a correct number. But when we talk about the ROCE, it takes into consideration both equity and debt, and it will give you the correct number. So sometimes it happens that whenever the company has debt, the financial analysts are still using ROE because they want to inflate this number. Because when people see this ROE number, they say the ROE is 30%, 40%, the company is doing so well, just buy that company. But when they actually see this ROCE, it might be just in early 2 digits, 12%, 13%, or might be just a single digit number. So always look into ROCE whenever the company has debt. So that's the thing that we need to understand in this perspective. Correct? The third metric which I tend to use is the cash ratio. Cash ratio from a liquidity perspective. I tend to look into the current ratio, the quick ratio, trying to take into consideration the liquidity position of the company by taking into consideration the current assets by the current liabilities. But I believe cash ratio is much more important, because cash ratio is taking into consideration your cash and cash equivalents by the current liability. Whereas the current ratio, it takes into consideration all the current assets. But the problem is the current assets might not get converted into cash so easily. So that's current assets. But the thing is, inventories in that component of current assets might take time to get liquidated. We might not get money from the debtors immediately. If we force them, a relationship might get hampered, right? The prepaid expenses are something which have been paid off already, right? So the most liquid cash or the most liquid current asset which is available to us is cash, because cash we can use instantly, right? And I'm also skeptical in most of the scenarios about the cash equivalents, because cash equivalents are the short-term money market instruments, right? Which might also take time to get liquidated. Because if my business needs some urgent money, if some kind of a creditor comes into place, or I go into some issues, not I, because I'm talking about the business goes into some issue, inventories might take time to get liquidated. You might not find a sufficient buyer. Debtors, it's something towards hampering your business if you are forcing your debtors to prepay your amount. Prepaid expenses you have paid already, correct? Cash equivalents, the short-term money market instruments, your debt instruments might take time to get liquidated. So cash is something which you have in hand, which is at your disposal in your bank account. You can use a Paytm, Google Pay, Phone Pay, hard cash in hand to pay off the liabilities. And that is why I focus towards the cash ratio more towards the over the current ratio and the quick ratio. Because if the current ratio or the quick ratio is higher, and that higher ratio is on account of your debtors, your prepaid expenses, inventories, in that case it might not be a good company. The current ratio or the quick ratio of the company should be high because of the cash ratio, which I believe. And that is why I focus more towards the free cash flow to share, your cash ratios, and I talked about the ROE and ROCE, when to use it and when not to use it. So first, I would say 4 metrics for this discussion, about talking about the free cash flow, the cash ratio, ROE and ROCE, and the next I'll be happy to discuss in the next session. So feel free to ping in your metrics as well, top 3 or 4 metrics which you guys use, and also you guys can also ping me about those metrics which you want me to discuss live through these short videos on LinkedIn or YouTube. Thank you guys.